Welcome to the Hurst Trading Room Live. My name is David Hickson, and today is the 18th of April 2016. As always, before we take a look at the markets, I would encourage you to read these disclaimers and make sure that you have understood them. I'm going to be taking a slightly different approach to today's webinar. We're changing the format ever so slightly. I've been receiving some wonderful feedback. Thank you so much to all of you who have sent emails or comments to us about these webinars. And in my effort to constantly improve the Hurst cycles information that I put out there, I am going to be taking a slightly more focused approach to today's webinar. And I am going to be focusing on one subject and one market, and I'm going to be speaking about only that. I hope that it provides you with a better webinar experience. What it means is that if you have other markets that you would like to take a look at or other markets you would like to discuss, then please let us know. You can, of course, enter a chat message, but I probably won't get to look at those markets during the course of today's webinar, but I will be sure to loop back and look at those markets in future webinars. I hope that the more focused approach is going to be more useful to you, and there's going to be less of me sort of banging on and going on about all kinds of other subjects that aren't really to the point. So, speaking of that, what is the subject of today's webinar? And the subject is, what does this recent strong move mean? In particular, here is a chart of the S&P 500. And if I can get this pen to work, this computer seems to have slowed down to a snail's pace. Here you can see, of course, a very prominent trough that formed on the 11th of February this year. And ever since then, the market has been moving steadily upwards, as you can see. It's pretty much described a fairly straight line since the beginning of February. Now, what does that mean? That's going to be the subject of today's webinar. In particular, does that very strong move indicate that the bull has returned to the markets? Because, of course, we saw a peak in the markets, most markets in 2015. Some markets formed peaks in 2014. And the markets seem to have been involved in what most people would describe as a topping process. They've been sort of turning over to the downside. And people have been beginning to wonder whether the markets are turning very bearish. Does this strong move recently indicate that the bull has returned? Or is this just simply another bounce up in the gradual turn into a bearish market? That's what I've decided we will discuss today. And I'm going to be focusing on that and really just looking at only one market, in particular the S&P 500. Of course, there's a tremendous benefit to be gained from looking at many different markets, the Dow Jones, the industrial average, the utilities, the transports, NASDAQ, the European markets, the DAX, and so forth. But for the purpose of focusing on today's subject, I'm going to be looking really at the S&P 500. So, looking at this move that has occurred since February, and let me just zoom in. The first thing that occurs to most people, particularly if they are new to Hurst cycles, is that when the market moves strongly in this way, it looks as if all the shorter cycles have disappeared. Because, of course, we expect cycles to create upwards moves in the market, and then we expect them to bring the market back down again and create a downwards move, and then an upwards move and a downwards move, and so on. We expect cycles to do that kind of thing to the market. When the market moves strongly in a straight line upwards, what tends to happen to new Hurst cycles analysts is they say, what is going on? Where have all those cycles gone to? Have the cycles disappeared? I know from experience, when I started working with Hurst cycles, I found the approach very interesting. I started applying it to my trading. It started really working for me. But then we would hit these strong moves in one direction or another, And the first thing that I would do is I would question the theory itself. I would question the concept of these cycles that keep moving in the market. I've since learned that that's a mistake, and that cycles don't disappear. It's one of the fundamental concepts of Hurst cycles, is that cycles don't disappear. They keep beating, but what tends to happen is they get squashed or overshadowed by the longer cycles. And so let's have a look at a theoretical chart. This is an old chestnut that I always pull up whenever I speak about cycles, and you're probably fairly familiar with it. I'm sure you've seen it somewhere, probably in one of my videos. This is a demonstration, if you like, of the results of combining many different cycles which follow the principles of Hurst's cycles, Hurst's principles that he defined in the 1970s. And I'm simply using an Excel spreadsheet here to combine those cycles to produce a theoretical or hypothetical price movement, which is that big, thick blue line that you see. That blue line is the result of combining the shorter cycle moves. The shorter cycles are at the foot of the chart. And let me just change the color of this pen so that I can show that. I see a question or two. I'm going to get to those questions in a moment. Here at the foot of the chart, you can see the sine waves of the separate cycles. And then we combine those cycles to produce this blue line over here, which is the hypothetical, theoretical price movement. Now, when we take a look at this chart, the one thing that should be fairly obvious straight away is that there are periods of time when all the shorter cycles are fairly apparent in the price movement, such as this period of time over here. I think you can see there that the shortest cycle in this particular example, which is this dark green cycle at the foot of the chart, the shortest cycle is very evident in the price movement. When you look at that price movement, you can see quite clearly that shortest cycle beating. It is causing price to rise, then drop, then rise, then drop, and so forth. Okay. Then there are other periods in this price movement where the shorter cycles seem to disappear, such as this period of time that I've just drawn an arrow pointing towards, and this period of time over here. What is happening during those periods of time? Is the shorter cycle no longer working? Has it disappeared? No, not at all. It is still there, and it is still beating, because we know that because this is an Excel spreadsheet. Okay, so we know that those numbers are still there, but it's impossible to see them because of the influence of the longer cycles, which are simply overshadowing the shorter cycle moves. I see a question from Luis. I hope that's how I pronounce your name. Would you consider the current move in the S&P a pseudo trend? That's a very interesting question, and I'm going to come back to it, Luis. If I forget, then please remind me. Pseudo trend is a very interesting concept and something that I would definitely like to speak about. I'm going to come back to it when we're looking at a chart of the market. So what am I showing you here with this Excel graph? I'm simply showing you that the shorter cycles can often or sometimes be overshadowed by those longer cycles. And so when the shorter cycles disappear, it is not a reason to start questioning whether Hurst cycles work. Okay. Instead, what we need to realize is that the longer cycles are simply applying quite a lot of influence onto the markets, and therefore the shorter cycles are being sort of squashed. So let's get back to the S&P 500 and let's consider this recent price move. If you've been watching these webinars and sort of tracking with us over the past few months, you will know that back in February we were speaking about the formation of this trough, and at that time I was speaking about that trough as being a trough of probably at least 40-week magnitude, perhaps 18-month magnitude. And for people who are new to Hurst cycles, that can be very disconcerting when we speak about the magnitude of a particular trough or peak being perhaps 40 weeks, perhaps 18 months. In fact, it's not something that should cause you to be concerned. It's not really something to worry about very much. Yes, of course, we want to accurately identify the magnitude of the troughs that form, but because of the way in which Hurst cycles work, it is often really possible to make clear trading decisions, even if you are uncertain about the exact magnitude of a particular trough or peak, as long as you know what the possible magnitudes are. And in today's webinar, I'm going to consider that trough on the 11th of February as having been a trough of 18-month magnitude. Then I'm going to show you a chart in which it seems very possible that it might even have been a trough of 54-month magnitude. That's 4.5 years. And then we'll take a look at a chart that considers maybe it was an even longer cycle trough. I did a webinar a few webinars back, I think it must have been in March, in which I took a look at the South African stock market and spoke about the possibility of that really long cycle trough forming, a 9-year cycle trough. Is it possible? Yes, it is possible, and we're going to take a look at that in a moment. Let me change the color of this pen again. There we go. And let me put up the FLD. Okay, so here we have a long move. A long straight line move. This straight line move, as I've mentioned, isn't cause for us to start thinking Hurst cycles are no longer working in the markets. Instead, we simply realize that the longer cycles are applying pressure, and therefore the shorter cycles are more difficult to identify. And you'll find when working with Sentient Trader that the software struggles to identify those cycle troughs. In fact, recently in the Hurst Signal service, you'll know that those shorter cycle troughs have been very difficult to identify, and they've remained as circles and whiskers. But let's take a look at this move and see if we can first of all work out where we are in this move. Although it's a fairly straight line, I believe we can fairly clearly work out where we are in the move, and then we can start thinking about what this strong move means in terms of what's going to happen next. So I'm going to display the FLD. The FLD is the future line of demarcation, and this is the 20-day FLD. Which you will know is a favorite tool of mine. It's a cycle tool. It's a very simple tool. It is the median price, which is the mid price between the high and low price of each bar, and it has been displaced to the right, in other words, into the future, by half of the cycle wavelength. This is the 20-day cycle FLD. I find it a very useful FLD because it tends to be a very reliable one. Now, the interaction between price and the FLD is fairly complex, but it's really wonderfully reliable. And so let's have a look at how price has interacted with this FLD and work out where we are in this pretty much straight line move. See if we can work out some of the details. First of all, having bounced out of the trough on the 11th of February, price crossed up above the 20-day FLD in this very nice clean cross, which ironically happened over a weekend. If I could have money for every time the 20-day FLD gets crossed over a weekend, I would be a wealthy man. And so that is our A category interaction, as price crossed up nice and neatly over that 20-day FLD. It reached up and it achieved its target, as you can see. It's just a very rough estimation of the target, but it reached its target over there in a typical A category interaction. Following that, we expect price to come back down to the FLD and find support at the FLD. I think you can see how it did exactly that. It found support on this day over here, and then again on this day over here. It found support at the level of the FLD. That process of finding support is an interaction between price and the FLD that we label a B category interaction, and it usually occurs around about the time of the 20-day cycle trough. So far so good. We've managed to identify a 20-day cycle trough within this upwards price movement. Then we get the C category interaction, which is price pulling up away from the FLD. It gets further away from the FLD. Then it comes down to it and is expected to cross down below it and come down to the 40-day cycle trough. Now here, according to this analysis, is the 40-day cycle trough over there. It's quite possibly also on this day over here, or more likely to be on that day over there. But as you can see, price didn't cross neatly down below the FLD. What did it do? It instead found support at the level of the FLD again. Now that's a very useful piece of information. FLDs often provide support and resistance. I say it again and again, but it always surprises me when I open up a chart and I see how many times support and resistance is being provided by an FLD. So our sequence, this should have been a D category interaction as price crossed down below the FLD. But instead of doing that, instead of crossing neatly below the FLD and moving down to its target, it found support at the FLD. What does that tell us? Or what should it have told us at the time? What it tells us is that we have the stronger influence of what's called a dominant cycle, which is a longer cycle, which is influencing the market and is providing quite a lot of impetus. When that happens, we realize that a longer cycle has kicked in and is providing us with some bullish power. And so we need to stay on our toes because of the fact that we have that longer cycle that is really helping to support the market. Let's keep going, because I'm going to sort of come back to that point, because we're in the same situation today in terms of there being a longer cycle providing impetus to this market. So I'm going to come back to that in terms of what we should do in working out what to expect next. So we had our D category interaction where price found support instead of crossing below it. That was followed by an E category interaction where price would normally cross up above the FLD, but in this case it simply bounced back up away from the FLD. Then it came down to the FLD over here in what should have been an F category interaction where it came down towards the 80-day cycle trough. So let's speak about this 80-day cycle trough. Here is a circle at the foot of the chart, which is part of the circle and whiskers for the 80-day cycle. That circle tells us exactly when we are expecting, or were expecting, the 80-day cycle trough to occur. I believe that was on the 7th of April. So that is when we expected the 80-day cycle trough to occur. The F category interaction is where price usually breaks down below the FLD on its way down to the 80-day cycle trough. As you can see, yet again, the FLD provided support, evidence that we have a longer cycle that is still providing some bullish power. Okay, and the next interaction was over here. That's a G category interaction, where normally the FLD provides resistance, but in fact price broke straight up above that FLD and headed up towards a new high for the move. Then it came down below the FLD and it formed a trough over here on the 7th of April, which is exactly when we expected the 80-day cycle to form a trough. At that point, our interest should definitely have been raised in the possibility that an 80-day cycle trough was forming in the market. What other evidence could we have used to consider whether that 80-day cycle trough was forming at that time? Well, there are various things that we could do. The one thing we can do is we can use basic principles, what I call going back to basic principles. When we have a bullish underlying trend, which means that the longer cycles are providing bullish pressure and are causing the markets to rise, when we have a bullish underlying trend, we expect cycle troughs to occur early. If you'd asked yourself on the 7th of April whether there was a bullish underlying trend, you almost certainly would have said yes. Why? Because our D category interaction was a situation where price found support at the FLD. a clear indication that we had a bullish underlying trend. Our F category interaction was also very disappointing in terms of not crossing down below the FLD, and was yet further evidence that we had a strong bullish underlying trend. So we would have definitely expected the cycle trough, the 80-day cycle trough, to have occurred early. And if I measure the number of days, you can see that trough occurred at 56 days. Now, the recent average wavelength of the 80-day cycle, if you can see, if you have really good eyes at the bottom right-hand corner of that chart, is currently 56.2 days. So, in fact, that has been the recent average of the 80-day cycle. And so when a trough formed at 56 days, it seemed very likely that that was a trough of the 80-day cycle. There's another way that you can use to help to corroborate your analysis, if you like, and that is to take a look at other markets. So let's take a very, very quick look at the DAX. This is the DAX, and here you can see a much clearer cycle shape for the DAX. And let's not dwell on the details. I'm not going to worry too much about the magnitude of that trough in this particular analysis. But here you can see the interactions are a little bit clearer in the analysis of the DAX. There's A, B, C, D, also slightly disappointing, but there's E, and here's the F category interaction, and price came down and formed a much clearer trough over here. As you can see, also on exactly the same day, well, no, perhaps a day after that trough was expected to form. So the fact that a much clearer trough formed in the DAX is probably a good indication that that 80-day cycle trough has formed in the S&P 500 and the US markets altogether. Of course, we have since seen high prices in the NASDAQ. We won't take a look at the NASDAQ, but by comparing different markets, you can certainly help to corroborate your ideas about the analysis and what's happening in the analysis. So it seems fairly reasonable to suggest that what we have seen here is an 80-day cycle trough. So what have we seen from this 80-day cycle so far? What have we seen in the most recent 80-day cycle? We've seen a move like that. As you can see, all the shorter cycles have been squeezed. That's because we have a dominant longer cycle. So clearly we have a longer cycle that is really driving this market upwards. Is that really good news? Does that mean that the bull has returned? Well, we need to start asking ourselves, what is that longer cycle? And at the moment, the truth is we cannot say with absolute confidence what that longer cycle is. And that's a very important point to bear in mind. Before we consider that in further detail, let's just quickly go back to our Excel spreadsheet, and let me point something out to you. That seems to have given us a black screen. Okay, let's try that again. There we go. Right, let me just keep this as a white pen. Hopefully it'll be legible enough. So let's assume that in terms of this hypothetical or theoretical model of price movement, this yellow cycle at the foot of the chart, I think you can see that arrow, that yellow cycle is the 80-day cycle that we have just witnessed. We've just seen an 80-day cycle play out. Now, if we have a look at the yellow cycle shapes in this particular chart, you can see that the first one, how shall I do this? The first one starts over here and goes up and then ends over there. That's the first yellow cycle. That's the second yellow cycle. And that's the third yellow cycle. Now, this chart has a dominant green cycle. I'm not going to give it a name. I'm just going to call it the green cycle. You can see that green cycle there at the foot of the chart. That's a dominant green cycle, and by dominant I mean that it's simply visually apparent. I use the term visually apparent because you can see it clearly, right? You can see price is moving up and then moving down over that green cycle wavelength. So the dominant cycle, here's the green cycle. Now, the big question is, have we witnessed recently in the markets this yellow cycle here for the 80-day cycle? I'll label that number 1. Or have we witnessed this one over here? That's number 2. Okay. It might seem like an obvious question, or the answer might seem obvious. You might be saying, well, obviously we've seen number 1, so we're going to see continued bullish moves carrying on. Well, that might be true, but it also might not, because if it turns out that our dominant cycle is not the green cycle in this diagram, but is in fact only one cycle longer, then our dominant cycle is going to be this cycle here, which gives us a strong move up, then a subtle trough, what is often referred to as a straddled trough, and then an equally strong move down. So it is quite possible that our 80-day cycle that we have seen recently is going to prove to be one of these cycles up at the top, and that what we're going to see next is that strong move down. So let's discuss what the possibilities are in terms of what is actually happening in the market. Okay, the first thing to consider, of course, is what is the magnitude of the trough that the market is bouncing out of. In this analysis, you can see it's bouncing out of an 18-month cycle trough. And if I zoom out a little bit on this chart, let's see if I can go all the way out. There we go, and show some semicircles, set a little bit of context for this particular analysis. Then you can see this analysis assumes that the 2009 trough, the March 2009 trough, was a very prominent trough, a trough of at least 54-month magnitude, probably 9-year magnitude, and that what we've seen since then is the move up, the formation of a peak, and of course we are now moving down into the next trough of the 9-year cycle, which is expected sometime around about the middle of next year. First of all, is this a possible scenario? Does this strong move up in the 80-day cycle that we've seen recently, does this negate that analysis? No, it doesn't. That's one of the really interesting things about working with Hurst cycles, is that the strong recent move in the 80-day cycle does not completely negate this analysis. If the dominant cycle, which is the powerful cycle, the cycle that's really controlling the market, if that cycle is of only 20-week magnitude, then let me zoom in again. If that cycle is of only 20-week magnitude, then what we're going to see is similar to the Excel chart that I have just shown you. What we're going to see is a fairly symmetrical movement around about the 80-day cycle trough. So as we've had a strong move up, so we will have a strong move down into the 20-week cycle trough, which you can see is expected probably sometime in June. That is completely possible. You have to be very careful, I believe, not to look at the recent move and say, wow, that was such a strong move. Clearly, the really long cycles have turned up. Obviously, the 9-year cycle trough has formed because we've seen 80 days of, or 60 days of strong upwards move. That's not the case. It is perfectly possible that the dominant cycle that is really causing this big move is in fact the 20-week cycle, in which case we're going to see a strong move down again. It's also possible, of course, that the 40-week cycle has been dominant, in which case what we are going to witness is a bit of a correction, perhaps, then a further move up, probably a new peak, and then a move down into the 40-day cycle trough over here. Okay, so we have to be careful of falling into the trap that just because price has moved up over the last 60 days means it's going to continue moving up, because clearly the very, very long cycle, such as the 4.5-year cycle or the 18-month cycle or the 9-year cycle, has turned and is therefore the dominant cycle. We have to be careful of making that mistake. Fortunately, there are ways of approaching this, which I'm going to get to help us to remove some of the confusion and to nevertheless make sensible trading decisions. Louise says, could it be possible that we have not seen the end of the 80-day cycle yet? Yes, Louise, it is possible that we haven't seen the end of the 80-day cycle yet. And in fact, that is why Sentient Trader hasn't positioned a diamond yet, because there isn't yet enough evidence that the 80-day cycle trough has completed. It is possible. And price could come down and form a deeper trough here and then bounce up like that, and that might turn out to be our 80-day cycle trough. But the question we need to ask ourselves, and remember that when we're performing an analysis, we're not dealing with absolute certainties, we're dealing with probabilities or possibilities. And we're trying to create, we're trying to put together a fairly complex puzzle. I personally believe that more aspects of this puzzle that we're putting together point towards the fact that the 80-day cycle trough did occur on the 7th of April, because of the fact that we clearly have a longer cycle which is dominant, 20 weeks or 40 weeks probably. And under those circumstances, we have a bullish underlying trend, which means we expect an early cycle trough. And the fact that a much clearer trough did form in the European markets. Those two things, I believe, tilt the odds in favor of the fact that the 80-day cycle trough has occurred. But you might be quite right. You have the 40-day cycle trough, you say, on the 24th of March. So there's the 24th of March, right? And that could well be a valid analysis. I'd like to, seeing as you've brought this up, let me just point something out. One of the most difficult times for a Hurst cycles analyst is when the markets form these straight lines, which is why I thought it would be an interesting subject of conversation today. It's one of the most difficult times for a cycle analyst because we are comparing the strength of various troughs. So, for instance, considering the 40-day cycle trough, we've got this move down here, which takes place over 1, 2, 3, 4 days to a trough there. We've got this move down, which takes place over 1, 2, 3, 4 days. It's very much the same move. And here you've got a little move that takes place over only 2 days. So, of course, Sentient Trader has done the unconventional thing by placing the 40-day cycle trough on that really small little move over there. We could spend a lot of time arguing whether the 40-day cycle trough is better placed here on the 24th of March or better placed here on the, about the 11th of March or something, or on the 15th of March, as Sentient Trader has done. And there's no absolute black and white answer. I cannot give you, an absolutely undeniably correct answer here. Your analysis might be correct, my analysis might be incorrect. But the important thing, I believe, is to look at as many factors as possible. And one of those factors is that we clearly have a bullish, longer cycle, either 20 weeks or 40 weeks, a dominant cycle, which is pushing these markets up. When you have a bullish dominant, a bullish longer cycle, cycle troughs of the shorter cycles occur earlier, as a general rule of thumb, which I believe tilts the odds in favor of the fact that the 80-day cycle trough has occurred. But this all has to do with probabilities and what is most likely. So it is possible that the 80-day cycle trough hasn't come in. I see that William says from a spectral viewpoint, it's most likely that the 40-week price wave has caused this advance. So that's great. Thank you, William. One of the real advantages of performing a spectral analysis, a slightly different way of approaching a Hurst cycle analysis, is that you can determine things such as which cycles are more likely to be dominant with a little more mathematical accuracy, if you like, rather than simply supposing or using various different pieces of evidence. You can use some mathematical evidence. And so William is saying that the 40-week cycle is more than likely going to be the dominant cycle. Okay. Let's take this argument a little step further, and I'm going to show you some other analyses. This is an analysis that has the 18-month cycle trough, and let me just zoom all the way out and put those semicircles on there. I find that a useful way of looking at the analysis. This analysis, as I've pointed out, has an 18-month cycle trough in February of this year, and the general picture is clearly that this strong rise has taken place within the context of the market moving down into a 4.5-year cycle trough that's expected next year. And as I've mentioned, it is perfectly possible that you have a very strong 40-week cycle that has taken control of the market. If this is a 40-week cycle, then if I can get my drawing roughly correct, then we would expect it to come up to a peak and then to come down again, probably fairly strongly, and then do one more bounce until the final drop like that. Okay, so the recent move up does not mean that we've definitely seen the trough of a much longer cycle, but it is possible, and let me show you some charts that demonstrate that. First of all, let's just go to the default analysis. I love to keep a default analysis running on all my charts. A default analysis is simply an analysis that I haven't messed around with, and in all the years that I've been working with Sentient Trader, I've been humbled to observe on many occasions that Sentient Trader performs a better analysis than I do. I consider myself a fairly experienced Hurst analyst, but Sentient Trader sometimes shows me up and points out that I'm wrong. And this is a default analysis that Sentient Trader has performed. And as you can see, let me just turn the pen on. There we go. This analysis has the rather questionable placement of the 9-year cycle trough over here in, where was that, 2011, I think. And the big trough in 2009 was only 18 months. We did a webinar in which this analysis was discussed. It caused a good deal of conversation, to put it mildly. And some comments on our YouTube video about the validity of this analysis. It's certainly an unusual analysis, and it might not be the correct analysis at all, but it is a possible analysis, and it's one worth considering. So this analysis has, as I think you can see, the 54-month cycle trough over here on that for that trough in February. And if I zoom in and take a look at that in more detail, let me turn off those semicircles. They always get a bit noisy when you're looking at the detail. Here we can see the same move, and we can see really pretty much the same recent analysis, except for the fact that this trough over here in February has been marked as a trough of the 54-month cycle, not a trough of the 18-month cycle. Now, if you're new to Hurst cycles, that might sound like a huge difference and something that we really need to think about and worry about. Personally, I don't believe it is a very big difference, and I'm going to explain to you now why. We've witnessed price bounce up, and it's bounced up strongly, yes. So clearly we have a longer cycle which is dominant. It's much too early for us to say whether this is the 54-month cycle that is suddenly giving us tremendous strength or the 18-month cycle. But we can work on the premise that the dominant cycle, and let me use these diamonds to demonstrate this to you, that the dominant cycle is at least of 20-week magnitude, and possibly, or probably, as William points out, of 40-week magnitude. So those are the cycles that we're focusing on, 20 weeks and 40 weeks. It might turn out to be the 18-month cycle that is proving to be very strong, or perhaps even the 54-month cycle. But I believe it's too early for us to determine that. Now, why do I not say that's really a particularly important consideration? Because what we need to do is, make our trading decisions day by day. And before we start making big assumptions about there being a dominant 54-month cycle, we need to ask ourselves, how do we treat this situation, and how do we make trading decisions on the basis of what we see happening now? That's the important point. And so what I would like to show you is an FLD on this chart. And that's the wrong FLD. That is an FLD that I want to show you, but it's the wrong one. First of all, let's start with the 20-day FLD. And I think you can see, if I zoom in a little bit, I think you can see here that this 20-day FLD is pretty much in exactly the same position as the 20-day FLD was in on the other analysis that had the 18-month cycle trough in the middle of February. This is one of the reasons why I really enjoy the FLD. Even if your analysis differs from one chart to another, very often you get similar FLD information on both charts. Not identical, of course, because the FLD is based upon the current wavelength of each cycle. And so if the analysis gives you different wavelengths for those cycles, then of course your FLD will differ. But now I would like to show you some other interesting FLD information. Let's start with the 20-week FLD. And let me just switch back to the chart that has the 18-month cycle trough. And let me zoom in there and show you the same FLD. I'm not going to do this for every single FLD. It's going to get a little tedious, but I will show you the same FLD on this chart, the 20-week FLD. Turn that one off. And there is the 20-week FLD on this chart. Now, notice one or two interesting points about this. When price hit the 20-week FLD over here, can you see what it did? It came down a little bit. In other words, it found temporary resistance, if you like, at that FLD. That is something that you will see again and again. The FLD works a little bit like a magnet. And when price hits it, it struggles to get out of the magnetic field, and then it eventually breaks away again. Okay, now the next thing you can do with an FLD is you can work out a target for a particular move. So let's work out the target for this move. Now, at what level did price actually cross this FLD? Because as it hit the FLD, or as it reached it, it moved down with it. Well, that's a good question, and we could discuss it in detail, but I'm just going to work out a very rough sort of crossing level, and I'm going to say that let's assume price crossed that FLD at about a level of 1987, 1990 perhaps, 1990. And this trough over here was a trough of 1810, roughly. So 1990, 1810, that's 180 points. Is that correct? I hope that's correct. And that, therefore, provides us with a target of about 2170. Okay, so that's off this chart over here. Now, of course, we could say, well, that price didn't really cross the FLD at exactly that level because, look, it tracked down with it, so maybe the price cross is a little lower. But however you calculate it, you're going to end up with a projection somewhere over here. sort of somewhere in this sort of region in terms of price. So we get the move up to the cross, and then we get an equal move up above it. So price hasn't actually reached that target yet. Now, does price always reach the target of an FLD cross? No, it doesn't. Very, very important point. The influence of the longer cycles will have a lot to do with whether it reaches that target or not. Now, if the 40-week cycle is currently dominant, as William suggests is likely because of his spectral analysis, then we would expect the price crossing of the 20-week cycle to reach that target. So we have a potential target for the top of this move. However, it is also possible, given the moves that we've seen so far, it is also possible that only the 20-week cycle is the dominant cycle, and that the cycles longer than the 20-week cycle are not very dominant. They're not really pushing price, which means that we probably do not have quite as much bullish pressure seeing us through into this target of the 20-week cycle cross. And therefore, that 20-week cycle cross is likely not to be fulfilled. One of the things that I quite like to do is I go back and I have a look at recent price crosses of a particular FLD. And I ask myself whether there is any evidence that could lead us to expect the current target to be achieved or not. So let's have a look at this FLD going back in time. Here, if we go all the way back to August of last year, you can see a period of time in which that FLD provided very accurate, pretty much perfect resistance for price. Price went up into that FLD, hit it, and couldn't go any further. Can you see that? It's a textbook example. I'm going to remember to take a shot of that. Then, of course, price dropped down below the FLD. Unfortunately, we don't have a target that has been generated from that move, so I can't really say anything about that. But we do have a target for this move here. Here is where price crossed that 20-week target, and can you see that that target was not fulfilled because it only came up that far. It only achieved about half of its move towards the target. That's an indication that recently, certainly, price crossing of the 20-week cycle FLD has not been as bullish as we might expect. What about the next interaction between the 20-week cycle FLD and price? Well, here you can see the FLD over there. I've drawn over it, so you can't really see it now, but price came down to the FLD, found support, tracked along that FLD. Isn't that amazing how that line, proved a very important line to the market throughout late December last year, and then price fell away. That generated a price cross. It's difficult to work out the exact point of the cross, but even if we're generous, and let me clear that pen, even if we're generous and assume that the price cross happened down here at the lower level, you can see that the move down exceeded that target, which would have been about there, exceeded that target to a good degree, indicating again that our price crossing of the 20-week cycle FLD has generally been unfulfilled to the upside, and it has been overfulfilled or surpassed to the downside, indicating that generally we seem to have quite a lot of bearish pressure when it comes to the 20-week cycle and price interacting with that FLD. I hope that makes sense. So price has interacted with the 20-week FLD here. The recent trend has been that upwards targets have not been fulfilled. So I'm going to be honest, I'm not holding my breath for this upwards target to be fulfilled. If it turns out that the 40-week cycle is dominant and not the 20-week cycle, then we would expect that target to be fulfilled, and in a few weeks' time we might be looking back and saying, well, there you go, it did fulfill the target. But it seems to me that the odds are in favor of that target not being fulfilled. Now, I was making a point earlier about these two analyses and how the 20-week FLD on this analysis is in pretty much exactly the same place as the 20-week FLD in this analysis. Isn't that a great thing? So it means that even though you have different analyses, you can look at the FLDs and you're seeing the same lines on your chart. It's a very important point. And that's one of the reasons why I don't worry too much about whether that's a trough of the 54-month cycle or the 18-month cycle. It's clearly a trough of at least the 18-month cycle. But the point is that we've had a very bullish 80-day cycle since then. Now what do we expect? Well, I'm not expecting this 20-week cycle target to be reached. And that target, as I've mentioned, we could work out exactly, but it's somewhere up above 2150, somewhere around about there. So I'm not expecting it to be reached. So I'm looking for price to go not very much higher before it turns down again. Now here's the next thing that I start doing. I start looking at other FLDs on the chart. And this is the 40-week cycle FLD. Now, isn't that a really interesting FLD? And if you've been watching it recently, you would have been amazed by how price has been tracking along this 40-week FLD. So here it crossed above the FLD, over here. Crossed above the FLD, but then it came straight back down to the FLD. It found support at the FLD, sort of slightly dropped below it over here, came back to the FLD, then it dropped below it, very importantly in my opinion, over here. Now it's come down and it's managed to pretty much sort of stick with that FLD. What is this picture telling us? Well, we could get very complicated and spend a long time talking about interactions between price and FLD, but I'm not going to get complicated for now. What I would like to point out is that this FLD, which is of course displaced price movement, indicates that we're seeing a clear cyclic rhythm. So we're simply seeing price repeating itself. Hurst cycles are really all about history repeats itself on many different rather complex levels, but we're seeing price and history repeat itself, and price has been tracking along this FLD very neatly, but it has shown some signs of weakness. Over here price dropped away from the FLD, and over here price dropped away from the FLD. What's expected to happen next? Well, the track that price is currently on, as you can see, is expected to peak in the near future and then start heading downwards. So this adds fuel, in my opinion, to the argument that we are very probably going to see a peak forming soon and price coming down again. So we need to be a little bit careful. Let's have a look at the 18-month cycle. And here again, we see a very interesting situation developing with the 18-month FLD. Now, we haven't seen price tracking along this FLD, but this FLD is drawing a line in the sand, if you like. It's showing us an area in terms of price and time that is going to be important to the markets. Make no mistake about it, it's going to be an important line. So what is going to happen? And now finally, at perhaps 53 minutes into today's webinar, I'm getting to the punchline. What does this recent strong move mean, and what are we going to do about it? What's it going to tell us? Well, the recent strong move means simply that we have a dominant 20-week or 40-week cycle, in my opinion. It doesn't mean there has been a return to the bull. It doesn't mean that we've seen a 9-year cycle trough, or necessarily that we've seen a 54-month cycle trough. It doesn't give us enough evidence to make those assumptions. Okay? Some people, some less experienced analysts might say because of that strong move, that clearly means the trough in February was a 54-month cycle trough. In this webinar, I'm trying to explain to you why I think that's a mistake. You cannot move, you cannot base that kind of decision purely on the recent 80-day cycle move, which has been very strong, but it hasn't been strong enough to prove that the trough in February was a 54-month cycle trough. However, this 18-month cycle FLD is providing us with a very useful line in the sand, because we definitely expect price to react to it. Now, the first thing that usually happens when price gets to an FLD is that it reacts. In other words, this FLD is probably going to provide some resistance to price. Okay, so we need to be watching this line very carefully over the next few weeks, because it is almost certainly going to provide resistance to price. The next thing we need to ask ourselves is price going to break up above the FLD, or is it going to stay down below it? Now, it's impossible to give an absolutely 100% confident answer to that without looking in much more detail at the longer term analysis. And I didn't want today's webinar to be too complex and too overbearing. My approach is this: I'm going to watch how price interacts with this 18-month FLD. I'll give it a little bit of leeway. I wouldn't be surprised to see price maybe breaking just slightly up above the FLD, but I would expect to see some resistance. If we see a really strong, clear break up above the 18-month FLD, then we know that the dominant cycle is almost certainly the 40-week cycle. So the shift of our perspective widens out a little bit. At the moment, we know that we have a dominant cycle of at least 20 weeks. Now, a 20-week dominant cycle, and if I go back very quickly to that Excel chart, a 20-week dominant cycle would mean that we are currently in this position over here. Here is our 20-week cycle from that trough to that trough. We're currently in this position here, so we should stand by and look out for the creation of a symmetrical price move, revealing a 20-week dominant cycle. So we need to stand by for that. It is very possible, and it's something we need to be wary of. Okay. If, on the other hand, price breaks strongly up above this 18-month cycle FLD, then it would be apparent that the 40-week cycle is probably the dominant cycle, and then our perspective will change a little bit. So I'll zoom back a little, zoom out a bit on this chart, and then we will be looking at a dominant 40-week cycle. And let me just turn that FLD off. And so if we have a dominant 40-week cycle, then we would be looking at something like this. We'll have the little blip for the 80-day, and then we'll get there to the peak, then down to 20 weeks, then the second peak, and then the move down. My point is that we could see continued bullishness all the way up to a peak here or a peak there. Can you see how at the moment, the situation at the moment is the same thing, but on a shorter time frame? Okay, so this line here is the situation if we have a 20-week dominant cycle, whereas this situation is if we have a 40-week dominant cycle. I hope that makes sense. So that really brings me to the conclusion of the main topic for today's webinar. I'm going to spend a minute or two showing you some composite model lines and explaining to you what those lines mean and what they might indicate we could expect. But the important point is this: because we've seen 60 days of strong bullish movement, does not mean that the bull has definitely undeniably returned. Of course, it's possible, and we might have seen a 54-month cycle trough, even a 9-year cycle trough form in the markets. But the important thing is, what it does tell us is that there is a dominant 20-week or 40-week, or possibly even longer. But we need to take this one step at a time. At the moment, we're clear that the dominant cycle is of at least 20-week magnitude. We need to be wary of price falling down soon, forming a peak and dropping soon, because that would indicate that it's only a 20-week cycle, which is dominant, which means that we're going to see some concerted moves down. Now, let me show you something else very interesting, and that is the VTL. Let me just zoom this chart out. A VTL is a valid trend line, and it is, of course, simply a trend line, but it is validated by the fact that it connects two peaks, two consecutive peaks or two consecutive troughs of a particular cycle. And the one that we're looking at here is the downward pointing trend line, which is this one over here. This is the trend line of the 40-week cycle, and it connects this peak of the 40-week cycle with this peak of the next 40-week cycle, you can see, and it then projects into the future. Can you see where price got up to last week? It is right at the level of that 40-week cycle VTL. Now, VTLs don't generally provide support and resistance to the extent that that the FLD does, in my opinion, but it is nevertheless an important level. Of course, we would expect price to break up above the 40-week cycle trough, 40-week cycle VTL, if the trough that it is bouncing out of is of 18-month or greater magnitude. So we do expect that VTL to be broken under normal circumstances. However, if the markets have turned bearish, if those longer cycles have turned bearish, then you're going to start to see cycles reaching back towards VTLs and failing to breach them. So that's so we're at a really critical point in the markets at the moment. I see a few questions, so let me see if I can answer those, and then we'll take a quick look at the composite model line before we wrap up today's webinar. All right, I see some comments from Louis about the FLD. Yes, it's a very powerful line, very useful line. Paul, what does the strong move down in the 18-month FLD in early May suggest? Okay, yes, that's a very interesting point. And Miguel says our bigger cycles match with all his other indicators. That's good. I do believe that Hurst cycles is a very powerful method to use in combination with other tools. And so when you see various tools showing you the same thing as your Hurst cycles are, then I think it's a very powerful combination. Very powerful tool to use in combination with other methods is what I'm trying to say. I've been speaking for too long. Okay, so Paul asked a very interesting question. What does the strong move down in the 18-month FLD in early May suggest? So here is the 18-month FLD. Of course, this FLD is simply displaced median price. So this is the move down 9 months ago, which must have been last year sometime. That's the strong move down in, was it August, that the markets came down very strongly? But what does it suggest? Okay, that's a really interesting question. What will often happen with an FLD is that you'll find price will come along and find resistance at the level of the FLD. I'm not saying this is definitely going to happen, but it often does. And then you get the FLD moving down. Now, if price crosses above this FLD here, then we would have to generate a target way up to, what would that be, 290 points, so 2390. We'd get a target right up there. What is more likely is if price breaks up above the FLD somewhere during this strong move down in May. Okay, if price, so let's just assume that price doesn't break that FLD, it comes down here, but does break back up above it here, then what does that tell us? What does it imply? It tells us that in fact the FLD target for the 18-month cycle is not in fact that high and is only over there. When you watch FLDs as much as I do, you're going to begin to notice how these patterns play out. And I've been watching FLDs on 1 minute charts recently, which has been a fascinating experience, 25-minute FLDs and so on. And you see these patterns playing out again and again and again. And very often when you see that kind of strong move down like that, so thanks for pointing it out, Paul, because it's a very interesting thing to consider. When you see that kind of move there, it indicates very often that in fact the genuine sort of meaning of price crossing this FLD might be really quite disappointing. We might see price crossing up above here. We need to look out for it, in which case we're looking at a bullish market for some time. But if price holds out and only crosses this FLD over here at the end of the first week of May, you can see how disappointing that target would be. That would give us a target over there. So that's something to look out for when you have an FLD that changes levels that quickly. It's something to look out for that that price crossing the FLD might not give you the really big impressive price cross that you were hoping for. Okay, now I said I would bring up the composite model line, so let me quickly do that and wrap up today's discussion. Right, let's first of all let's zoom out here, and let me just remind you what a composite model line is. A composite model line is where the software takes the cycle information that it has, where it takes all of that cycle information and it puts it back together again. And so it extracts cycle information from the price movement, then it puts it back together again and says, this is what the cycle information tells me was happening in the markets. Where price differs from what the cycle information tells us is very useful and very important, because it tells us where other influences were coming into play and were affecting the market, not simply the cycles. Right, so here is the composite model line for the analysis that assumes that the 54-month cycle trough occurred in February of 2016. What this tells us very simply is that if the cycles continue to beat with the same rhythm and the same amplitude as they have done recently, then we are expecting the market to come up and form another peak over here towards the end of 2017, early 2018, before coming back down again. That's the really sort of big picture that it shows us. Now let's zoom in and see what it tells us to expect now, because that's really what today's webinar has been about. What do we expect to happen now? As you can see, the composite model line tells us to expect a peak really soon. In fact, I think that composite model line turned, in the past weekend. So the composite model line tells us to expect price to drop all the way down to the end of May or beginning of June. So we're going to see a move down like that before price comes up, forms another peak over here in September, and then forms a peak which will probably a trough, which will probably be a trough of the 40-week cycle over here in October. Now that's on the basis of that analysis, the 54-month cycle trough in February. Let's take a quick look at the other analysis we've been looking at, which is the 18-month cycle trough in February. And let me just zoom back to a sensible, let me just reset this before I step through 100 zoom levels. Okay, and so there we go, there we have it. And let's display our composite model line. Now the composite model line for this shows a slightly different picture, but before you jump on the chat window and say what on earth is going on, you must bear in mind that this analysis has fewer longer cycles, so it's providing us with less longer term information generally. But this analysis, again, the composite model line in terms of the bigger picture, is telling us to expect a move down into the middle of 2017. Then we get the market coming up to a peak in the end of 2019, and then we get the big move down following that. Okay, let's zoom in and have a look at the recent move, or what the composite model line tells us to expect now. And here you can see that the composite model line tells us exactly the same thing. It's telling us to expect a peak round about now, followed by a fairly strong move down into this 20-week cycle trough over here, also at the beginning of June. So this composite model line tells us to expect a very similar thing in the near term. And I believe it's very important. Of course, you look at the big picture and you start thinking about, is there going to be another peak in 2019? That's very interesting. But personally, I'm more interested in what's going to happen over the next few weeks. And I know many traders are more interested in what's going to happen over the next 15 minutes. And they're not that interested in what's going to happen in 2019. Now, before I end today's webinar, I'd like to throw one more chart at you very quickly. What if the trough we've been speaking about in February was not 18 months, it was not 54 months? What if it was 9 years? Well, in fact, I can't get Sentient Trader to sensibly position a 9-year cycle trough in that position for the S&P 500. But using a shorter nominal model, and we won't dwell on it now, but using the shorter nominal model that was shared with us by John in a webinar that we held last year, in which case the cycle, the 9-year cycle is not a 9-year cycle, but in fact a 7-year cycle. Using that nominal model, I am able to position a 9-year, or I should call it a 7-year cycle trough in February of 2016. Now, I want to just sort of really prove the point to you that the magnitude of that trough in February does not necessarily tell us what to expect. No, I should be very careful how I word that. Of course, it tells us what to expect. What I should say, to be more specific about it, is that even if the trough in February of 2016 was a trough of 7 years, that doesn't necessarily mean that we've got to look forward to 3.5 years of bullish stock markets. And it certainly isn't a reason, now that we've seen 60 days of bullishness, it isn't a reason for us to celebrate and say we're heading up into much higher highs. We might indeed be heading into higher highs, but they might not be that higher. Do you remember the Excel chart that I keep showing you, where you get the strong move up, and then you get the move like that, and then it turns out to be symmetrical, and then it comes down again. Even if this trough in February of 2016 was a trough of the 7-year cycle, or maybe the 9-year cycle, it doesn't necessarily mean that we're looking at many, many years of bullishness lying ahead. And so let me turn on the composite model line for this analysis, which shows us a very interesting picture. How do you like that? Now, again, the composite model line is taking the cycle information that it has and it's putting it together. It should be no surprise that what we're seeing here is a nice M-shaped cycle. Okay, there's your M-shaped cycle, and it's in your composite model line. But what is this composite model telling us in terms of the longer-term picture? It's telling us that even if this was a trough of the 7-year cycle in February of this year, we are expecting a move up to a peak towards the end of 2017, perhaps early 2018, and then we're looking at a strong move down. Can you see how the 3 analyses that I've shown you, 18-month, 54-month, and 9-year or 7-year magnitude for the February trough, are all giving us a very similar long-term picture? And what does this analysis tell us to expect in the near term? Well, the picture in the near term is even more worrying or devastating than it might have seemed in the other charts. First of all, it is definitely expecting us to. It's telling us to expect a continued bullish move, and then it's looking at the market tipping over and forming a trough over here. Now, can you see this nice clear cycle shape? What cycle is that? I'm sure you can see that very clearly. It is the 40-week cycle. And William mentioned earlier that the 40-week cycle is very possibly or probably the dominant cycle that is currently moving the markets. Well, here's a composite model line that shows exactly that. It shows us a dominant 40-week cycle that is going to come down and form a trough in about August, September of this year. It'll be a dominant 40-week cycle. Is telling us to expect more of a bullish move now, followed by a move down. Okay, let me see. There were a few more questions, I think, and then I will bring today's webinar to an end. Miguel was expecting a waterfall from 28th of April to 5th of May, but holding your FLD lines perfect match. Okay, I think we've sort of passed the point at which I can comment about that. And February 2016, second 54 of a 9-year cycle. So Louise is suggesting that we saw a 54-month cycle trough, I think. And William, that analysis is much more in line with her spectral analysis. There we go. So I think this analysis that we're looking at now, if I've got my timing right, is the analysis that's more in line with William's spectral analysis approach. And I see Louise clarifying the February 2016, the beginning of the second 54-month cycle of the 9-year cycle, and a summer peak and down into the US elections, John is asking William. So I hope that today's webinar has been packed with information. I did try to focus on one subject and keep it straightforward. My point in summarizing today's webinar is really that because we have seen 60 days of a strong bullish move doesn't mean that we have definitely witnessed a lasting change in the markets. There are two possibilities, in my opinion, in terms of what can happen now. The one is that we have a 20-week dominant cycle, which means we would expect the markets to turn down fairly soon and come into that trough in about late May, early June of this year. And we need to watch that 18-month cycle FLD line for evidence that it cannot get through it, and we need to stand by for that turn down. The other possibility is that we have a 40-week cycle which is dominant, in which case we will see a continued bullish move up to the levels that are fairly accurately shown there by this composite model line above the 2150 level. And then we will see a peak form, and we'll see the market move down into the 40-week cycle trough, which should occur in about perhaps September, October this year. That brings an end to today's webinar. Thank you so much for joining me. Thank you for your interest in Hurst cycles and for being here with me today. I look forward to seeing you at our next webinar. We will be doing our next webinar in 2 weeks' time. If you have suggestions for subjects for the webinar, then please do email them to us. I'm going to try to keep refining this webinar process and keeping the focus going, because I think it provides us with a more satisfying webinar all around. So please do email any subjects or topics that you would particularly like me to deal with. In the meantime, I wish you profitable trading. Make sure you keep your eye on that 18-month cycle FLD line, and make sure you have everything in place to profit from the last little burst of bullish move that we might have, or the bearish move that might be coming really soon.